Have you ever stopped and wondered what's really moving the stock market? I mean, beyond all the headlines and the TV pundits, there's this invisible engine humming away, a whole world of algorithms making these split-second decisions. Well, today, we're going to pull back that curtain and see exactly how these machines see and react to risk.
So, picture this. It's May 6th, 2010. Everything seems normal. Then, all of a sudden, the Dow Jones Industrial Average just nosedives. We're talking almost 1,000 points. $1 trillion of value just gone, poof. And then, minutes later, it all reappears. It was like a ghost in the machine, this massive market seizure that left absolutely everyone asking the same thing.
What was that invisible force? Was it just some crazy one-time glitch? Or was it a sign of something much deeper, a new kind of fragility baked into our modern markets? Well, these are the exact questions we're going to dig into today. And believe me, the answers all come down to understanding how machines perceive danger.
Okay, so to start, let's put on our defensive hats. Imagine you're trying to spot a hidden poison in a massive, fast-moving river of millions of trades. How would you do it? Well, this challenge led researchers to develop something that's basically a toxicity meter for the market. And the key concept here is something called order flow toxicity. So imagine you're a market maker. Your whole job is to be ready to buy when people want to sell and sell when people want to buy. But what happens if a huge wave of sellers comes at you and they all know something you don't? You end up buying a ton of stock that's about to tank. That one-sided informed flow, that's toxic. It's poisonous, and it can totally wipe you out.
See, the big problem was that the old tools for spotting this kind of sneaky, informed trading were just way too slow for today's high-frequency world. They needed a much better smoke detector, one that could scream its head off before the entire building was engulfed in flames.
And that's where this new tool, VPIN, comes into the picture. The old model, called PIN, would give you maybe one reading for the entire day. I mean, in the world of high-frequency trading, a whole day is an eternity. VPIN, which stands for Volume Synchronized Probability of Informed Trading, was built for pure speed. It gives you readings within the day, so you get a real-time pulse on the market's health.
So how in the world does VPIN get that speed? Well, one of the key innovations was genius. It switched from tracking clock time to tracking volume time. So instead of taking a snapshot every, say, 60 seconds, it takes a snapshot every time a certain number of shares get traded. What does that mean? It means when the market goes crazy and activity explodes, VPIN's analysis speeds up right along with it. And that, right there, is absolutely critical.
And here's the crucial link. When those VPIN readings spike, it's a massive red flag for high toxicity. All the high-frequency market makers see this, they hit the panic button, pull their orders, and just vanish. And what happens when the buyers and sellers of last resort all disappear at once? You get a flash crash. Research actually shows VPIN levels went through the roof right around the 2010 crash. It was the smoke detector, just screaming.
Okay, so that's the defensive side, reading that toxic flow. But what about offense? What if you're the one making a huge trade? How do algorithms figure out the kind of ripple effect your actions are going to have on the entire market? Well, for years, traders have been using this surprisingly simple rule of thumb. It's called the square root law, and it basically says that the impact your trade has on the price isn't a straight line. So doubling your order size doesn't double the price impact. Nope. Instead, the impact is proportional to the square root of your order size relative to the market's total volume.
I know. It's a really clean, simple formula, which in the messy, chaotic world of finance should make you just a little bit suspicious, right? Does this little back-of-the-envelope calculation actually hold up when there's real money on the line?
Well, the answer, it turns out, is a resounding yes. It actually does. This graph here plots the real-world price impact from almost 500,000 trades, and you can see it. The data follows that square root law, that solid black line, with incredible accuracy. It's not just some nice theory, it's basically an empirically verified law of the market.
So we've got a tool to read the flow, VPIN, and we've got a law to predict our own impact, the square root law. Case closed, right? We're done. Well, not quite. You see, knowing that something happens is very different from knowing why it happens. And that search for the perfect why is where things get really fascinating. Think of it this way. The square root law gives us the what. It describes the outcome. But what's happening under the hood? What are the actual mechanics in the market's plumbing that make this happen? On this question, some of the smartest people in quantitative finance just don't agree. And they've built all these competing models to try and prove their case.
And this table here really lays out the trade-offs. You've got models like the propagator model, which is super practical for everyday use, but it's not built on the most solid theoretical ground. And crucially, it might even allow for price manipulation. On the flip side, you have these other models, like Alphonsi-Sheed, that are way more sound in theory, and they prevent manipulation, but they're much harder to actually apply in the real world. So it's this constant tug of war between what's practical and what's theoretically pure.
And here's why that trade-off is such a big deal. The model you pick completely changes your strategy. On the left, the propagator model tells you the best way to trade is in these short, intense bursts. But look at the right. Other models say the best strategy is this bucket shape. You trade heavily at the beginning and the end, but keep a steady pace in the middle. We're not talking about small tweaks here. These are completely different playbooks.
So, okay, we've got toxic flows, we've got square root laws, and all these competing models of reality. Why does any of this complex algorithmic stuff matter to the rest of us? Let's zoom out and bring it all together. All right, so what's the bottom line here? First, this invisible engine driving the market has very real hidden risks, like toxicity, that can threaten the whole system's stability. And yeah, that includes the retirement accounts that we all depend on. Second, the good news is we're building really sophisticated warning systems like VPIN to spot those dangers. Third, there are predictable patterns, like the square root law, that actually govern this complex world. And finally, behind it all, there's this intense, ongoing intellectual arms race to build the one perfect model that explains how the whole shebang truly works.
And that leaves us with one last, pretty crucial question. As our markets get faster, more complex, and more interconnected every single day, are our models actually getting smarter? Or are we just building better and better tools to measure the tremors of a system that is, and maybe always will be, fundamentally beyond our complete control?